For me, it's a little bit like coming in the cave of the lion as a fundamentalist, as to say. So therefore, I heard quite a lot about smart and beta today, and I think we have some interesting topics and hopefully a harsh discussion.
Yeah, you should have been here yesterday. I think yesterday was pretty critical of smart beta, I think. So some of your supporters were there yesterday. So what we thought we would do is we do a very brief introduction for each of us. You can call it a starting plaidoyer if you want for each of the sides, pulling up the usual stats that we would do just to set the scene. And then we're going to ask Paul to help us through a discussion that's hopefully quite entertaining. So we each put a little bit of material together. You can run through yours if you like, and then I'll go second. One more. Here we go.
Yeah, taking a look at beta, smart beta. The problem is that it's just not anything else, just a quantitative way to approach things. The big problem is that nowadays you have in your pocket a telephone which could land Apollo 11 on the moon, and even you can still play Angry Birds with it. The technology changes over the last decades has been strongly, and there are a lot of Russian rocket scientists out there who have entered the financial markets. The big problems that we always see, especially when there are break in long-lasting trends, and especially nowadays, and the computerization over the last 40 years has also led to something else, that the expectations of all the sell-side analysts are easily available for everybody. The problem is that even those sell-side analysts tend to work around a consensus or the expectations also given, the guidance given by some companies. And herein lies one of the big problems. For example, if I've just taken a look in the April 2014, the Euro STOXX select 30 dividends with 30 constituents. And at the end of the year, we've taken a look in the rear mirror. And we've seen that out of those 30 companies, 5 of them have strongly lowered their dividend. Even one, Alstom, has paid nil. And you have seen, I think, a lot of dividend smart beta strategies starting from 2006 were heavily relying on utilities. You can ask the German retail investors and a lot of pension funds how much they have loved E.ON and RWE. But in fact, they had a break in their business model. But the consensus was very late to react to these fundamental changes that are going on there. And please don't discuss with me today the dividend expectations of Volkswagen or BMW. No, but here you can see really in real life the problems that lie within. It has nothing to do with the smartness of the strategies used there. But the data they are relying on is most of the time very awry. And most of the times you can see, especially when there are big breaks in structural points, you will have a lot of problems if you rely on these consensus data. You also mentioned balance sheet data. Remembering the financial crisis, the strong equity base of a lot of US, American, and British banks evaporated overnight. And even nowadays, if you take a look at the developments at RWE and E.ON, who, like 5 years, most of us still remember one of the safest balance sheets in the world. They have now market caps which are trading at a low percentage of their enterprise value. And if you take a look at the CDSs, what they are telling is a very, very bright future. So maybe just to put it it's not that easy just to say, oh, I have a quantitative strategy and relying on the consensus data. It is very, very difficult. And therefore, that comes to my other point, because we launched a dividend fund a few months ago, and I did even the same thing with my prior employer, where I said I don't want to have any benchmark at all. Because most of the dividend funds and dividend strategies, where most of the people say you want to have a market performance, strong income, but hopefully some lower exposure rather than the broad markets. They were deeply surprised during the financial crisis that they didn't have a diversified approach. Because of these consensus data and the market caps, you were not diversified because you had over 40% in financial stocks. It's like taking a look back at the end of '99, where you had, when you bought the S&P 500 or even the DAX, where you had over 20% exposure out of Deutsche Telekom and the technology. And even prior to that, we've seen that. Like in 1980, where you had, I think, over 30% of the S&P 500 constituting of oil companies, because oil prices were very high. So therefore, I think it's very, very important that you first of all diversify through regions, sectors, market caps. And secondly, that you're really taking also an active approach into the data you are mining, as to say.
Okay, I'm sort of twitching to answer to some of those points, but I'll go through the scripted start first. Allow me to turn that picture upside down, right, and look into the passive side of things. And I'm not going to say too much, and I'm not going to quote too many things, but I do want to very briefly look at one of the many studies that talk about active versus passive. And I want to talk briefly about how we construct dividend indices, just to put a little counterweight to what you're doing, or at least also to support you in some cases. So, we index providers love these studies. Right? They show you that the funds don't outperform their stated benchmarks. This one's from Vanguard, about funds that are available to US investors and over various time periods. I like this one. The study is huge. There's all sorts of different classifications into different styles and things. But I like this one. It's the whole data set, and it looks at bull and bear markets, and it looks at different time frames. And you can see, obviously, there are some time frames. And what this shows, sorry for those of you in the back, is the percentage of managers that outperform their stated benchmark. And the line in the middle is the 50%. So if the line's at 50%, you have a 50% chance on whether your fund will outperform its stated benchmark or not. And you can see that is the case in some phase. There's some exposures in the 80s, in the early 80s, where it's up to 70%. And then more recently, we've had 50% or less. And that sort of ultimately is the index argument. And I'd love to pick up your recipe thing, because that works for me very well too. And I'll go home briefly. So my wife always criticizes me because I'm a recipe cooker. So whenever I cook, which thankfully isn't all that often, I'll look at the recipe book and I'll do absolutely everything exactly like it's written in the recipe, because I'm scared of messing it up. Whereas my wife will probably never look at all those recipe books I've bought her over the years of Christmas. I just look at them. And she just goes, oh, well, intuitively, throw some sugar in here, a bit more salt. Oh, I can't put that much flour into this thing. So in the end, most of the time, luckily for me, she outperforms the benchmark, and it actually tastes quite good. But from time to time, there's those meals where you're looking the number for the pizza service up rather quickly. And it's that risk that I'm not willing to take, because I don't want to be blamed the 3 times a year that I cook that I mess something up. So I'm a recipe cooker, and I'm a recipe cooker at work too. And to some extent, the index represents the recipe. And we don't claim to be perfect, right? To some extent, we just go for the middle. I'm pretty content with the middle, because the risk of having a bad meal at the moment seems a little bit too high. And we can debate that, of course. And in terms of how we do things, and I'm just going to confirm some of the things you say, right? We basically look at two ways of creating dividend indices in this specific case. So we have our select dividend methodology, which takes the highest dividend payers with the mentioned issues, but also with a very simple and easily replicable approach. We also have that maximum dividend concept, which you probably like even less, which looks forward and takes consensus forecasts on dividends and selects components based on that. And then, of course, and over the years, the concerns that you've mentioned have in part been picked up by the indexing industry, right? So you can kick out components that drastically reduce their dividends or that stop paying dividends. You can do that. Probably do it too late because it's already been announced, right? You can have, which is S&P do that a lot. You can require a huge amount of consistency, 25 years of dividend growth and so on, which they do. You can adjust your weighting. You can weigh by yield. You can weigh by market cap. You could even go and put sector constraints and caps in. But I think there's a point where you've got to stop detailing the recipe out any further. The recipe forms some sort of basis. If you want to put in extra sugar, go ahead. I'm not going to do it. So I think that's sort of the intros. Yeah? I just, to show you the nice features of Prezi, played around a little bit and say, okay, so maybe we are arguing here, but in the end, I do believe that active and passive kind of coexist in a rather harmonious way. But let's debate.
Yeah, sure. So thank you very much, gentlemen. It's very interesting setup for the debate. I'd like to start with you, Konrad, and ask, or rather remake Thomas's point. Surely he's right in saying that if you construct an index based on backward-looking measures, in this case, looking at dividends, you're going to have something that is not going to tell you when things change. So he gave the example of utilities and recently cutting their dividends. We don't know what's going to happen to Volkswagen and BMW, but there's a high chance they're going to do the same. And then obviously in 2008, banks were a big proportion of dividend indices, and they ended up cutting them, and many of their stocks fell 70, 80%. So doesn't he have a very good point there that you're investing, looking forward, using a very backward-looking measure?
He has an excellent point, and I spent the whole day yesterday listening to people making a similar point, also about market cap weighted indices. You're putting the most money into the thing at the worst possible point, and so on. And it's true. There is no denying the fact that this is happening. Now, the other point though is we're using it as a proxy. We're using the historical data as a proxy for the future, which we all put in our disclaimers that we never should do that, right? But in the end of the day, that's what gets done, and that's what the index is. But there's also it's been proven that proxy actually works reasonably well. It works recipe 50% well. And my point sort of back is, yes, we know of those structural issues. We know that a market cap weighted index invests at the most money at the worst times. We know dividend indices probably don't see the future very well. On the other hand, we seem to, without the hindsight piece, because the RWE Aeon thing, you would have to predict that. Very few people actually manage to predict that. And now it's down to how good is your cook or your fund manager and whether he's able to predict that. And I think from the index provider's point of view, you can go the safe way and use a standard benchmark that has a somewhat proven track record of predicting it in some way, knowing it has certain deficiencies that may be compensated by somebody having enough foresight to do it right. And not everybody does, I think.
Okay, so Thomas, what about Konrad's point that even accepting that what you say is true about backward-looking index construction rules, most active managers don't manage to outperform their benchmark anyway. So even if that is correct, what reassurances can you give us that you'll do better than those partly faulty rules?
Absolutely, I can guarantee nothing, but for sure you can take a look at the track record and history. And I managed the Munich Global Fund when it was a small one, outperformed I think 9 out of 10 years after costs, and I think we at MindFirst, we have a strong culture of saying we have high active share. I'm a little blaming my own industry, as to say, because we've done a lot of things wrong over the last years. I think there's a lot of enhanced indexing going around, where you tell people that you are an active manager and at least you're not doing it, because you're afraid of career risk or whatever. I can tell you we have, and this is statistically shown, we have some of the highest active shares in the industries within our firm, and we have to. And we also tell our clients there will be years when we will not do that well. But the good thing is that we have fund managers at our firm who are committed to active fund management. And we've won several awards. Recently, Olga Eichler won one with this European fund. But for sure, there is some risk inherent into this. But I think we need, as an industry, a wake-up call, really, to if we charge a lot of money and we're not offering or taking the risk, then there will be no chance for us. Then ETFs, and then I've learned from them in the 90s when I started in the industry, when I was in the US, and it was for sure when I went into that business that, and it makes you humble, that you have to do very good work and you try your best and not just mingle around an index. And I think this is the worst thing, that now most of the active fund managers are more or less enhanced indexing, and so they can't beat.
Do you have many clients who are telling you, we accept what you're saying, so we're very happy for you to take bigger active bets and to have wider swings in performance against the index?
Actually, we have to find these clients. And the most important thing is that the clients have to be sure and willing to take that risk. But when no one in the whole industry takes any risk at all, everybody does the same. And I think there are a lot of institutional investors out there, retail, also family office, who are actually willing to take risk. But they want to see a track record. And the most important thing is they have to understand the investment culture and the investment process of the manager. And this also takes time. But I think this is the most important thing.
And you mentioned during your presentation that you had made a case for starting a new fund without any benchmark. What response did you get to that?
I can tell you it was really very, very tough. I got a lot of pushbacks. And even if you convince people, and this was 2010, after the aftermath, it was still very tough to convince people about that. But the more people have learned about the strategy and the performance has shown itself, and actually we really did what we were telling clients what the fund would do, in good and bad times. For example, if biotech is going through the roof like it has last year, for sure, a fundamentally conservative dividend fund will not participate into such a rally. This also has to be sure. But it's really that you make clients understand what you do, and this is very tough. And I think I'm a little bit afraid about I've seen the rally in smart beta, especially in the US now. I think 440 billion out of 1.8 billion in ETFs. And a lot of them are in dividend strategies in the US, quality, and some in momentum. And interestingly, these inflows have started in the aftermath of the financial crisis, where a lot of those strategies, for example, you had Procter & Gamble paying dividends since 1890, outperforming strongly and had a revaluation, where this strategy really worked. And I'm a little bit afraid that like often in the financial industry, that people get on the train a little bit late. And I see also one risk, like you mentioned it, it's a tradable form. It's easier for people. I can understand the advantages of that, and they're undoubtedly there. It's easier for people to trade these strategies. And I think there is still a lot of emotions in the financial industry, like depression when things are down, like euphoria when things are good, that will also lead to a much higher, good for you, velocity of trading such strategies. And I think if these will be, and this has history shown through all the decades, if this is a good guide for most of the investors, I'm a little bit skeptical.
Konrad, you made a point earlier that you don't want to overcomplicate the recipe, so you don't want to add endless modifications to the basic dividend approach. But having said that, people do want to add things like sustainability measures or maximum payout ratios and so on. But what you said reminded me of one of the slides we saw yesterday that I think it was 700 or so smart beta ETFs worldwide, but there are 600 underlying smart beta indices. So it looks as though the index industry as a whole will create any version of anything, because I suppose the cost of doing so is minimal. So how do you draw the line? I can understand what you're saying, but it doesn't look as if in practice, if someone comes to you tomorrow and says, I want to have this version of a dividend index or this version of that smart beta approach, that you'll actually turn them down.
No, we don't run away from business in principle. Yeah, so we're open for business. Please come, we'll build your index. On the other hand, there's a bespoke business, and I remember back 5 years ago or something when we wrote an Agenda 2020 in terms of where's the business going to go. We predicted that in numbers of indices would go up, and they would go up because the demand differentiates, right? I mean, when indexing started, you had 5 benchmarks and everybody used those, and that was where all the liquidity was concentrated. And that's, generalizing a little bit, still where all the liquidity is concentrated. But there is now 10 million other indices that have come out around it, partially just for a single client or individual clients. Looking at, and I think the previous talk gave us kind of some example on how an index with very specific criteria gets created, because there's an investor with a very specific need. So I would differentiate slightly between creating an index as a vehicle for somebody to invest with a specific purpose, as shown in the previous panel, and having sort of flagship indices that measure certain things. And that's sort of where I made the point of saying I'm not going to further differentiate my flagship dividend index in order to address all of those points, because they may be relevant to one investor, but not necessarily to the other investor. So picking up the point about diversification, right? I mean, if I'm going to put my entire portfolio into that index, it becomes a real problem. If I'm going to use it as a satellite to a larger core allocation, it may not be such a problem that I have, that I take a certain sector bias. In fact, I may even like that particular bias because I'm taking a bet, and so I think that's where it gets difficult. And I think, and I like the point you made about the benchmark huggers that draw down the entire active industry. I don't actually, I don't have anything against active managers, right? And coming back to my recipe example, I'm totally happy for the Michelin-starred cook to deviate from the recipe. I think it'd be very boring to go out and pay 100 euros per head to eat something that I could have cooked at home, because he uses exactly the same recipe. And a Michelin-starred cook doesn't star because he's very good at following recipes. You know, they star because they do things differently, and most of the time things taste good. So I love skill, and I'm happy to reward skill. And it's just that when you cannot determine how much of the skill of the Michelin-starred cook is actually him and his unique thing, or is he just cooking by a recipe that could actually be available to everybody out there. And to some extent, a dividend benchmark, if we assume that your fund does very well and you do not need a benchmark, still I think people would want to see how much of that is you and how much of that is just doing a dogs of the Dow strategy, which has been around since the 60s, and you're taking the lowest or the highest dividend yield stocks, and so it's taking that piece out. And I think that's the other function of the index, is to simply say, look, we should compare this fund, even though you may not have a stated benchmark. I think it's still valuable to compare it to a standard benchmark, compare it to a dividend benchmark, just to see, saying, could I have gotten that same stuff from a basic recipe and didn't have to go to a restaurant?
To what extent are the rising inflows into index tracking products in general, including smart beta, making it easier for you to do your job by throwing up inefficiencies in the market? Can you give us some examples of what you've seen?
Yeah, that's a very good point. I also wanted to make, but it is not that easy like you would think. In general, I really see that this herd following is giving us the opportunity also to get good companies at a reasonable price. But nevertheless, like we've seen right now in July during the crisis, these are big forces which drive down a lot of things where correlations spike. Also for asset allocators, a very big problem going forward, where we have quantitative strategy relying on volatility, who sell whatever it takes. So this is also forcing a lot of uncertainty. And these disruptive days are good for us because there are prices which are really absolute crazy. But nevertheless, it makes you sweat and it makes all the clients sweat. And I think you will see the results of the disruptions we had over the summer. We will see in the following months because a lot of investors are drawing back from an active asset allocation approach, really where to put their money, and even below zero, they put their money in cash. So this also has a lot of increases a lot of problems for all of us.
Konrad, could you explain what kinds of things index firms can do to minimize turnover when something changes? So, for example, if dividends change, or we heard earlier that balance sheet measures can be very volatile from one year to the next. What kinds of things do index providers take into account when designing indices to prevent very high levels of turnover?
Well, first of all, it's the realization turnover is bad, right? We understand that you're trying to be consistent, and we don't have the benefit of being able to individually react to a situation. So we need a bunch of rules that ultimately, the bait is gone. What a shame. Just move it. We do have to have rules that hold up all the time, right? So we do need to adjust or make our rules somewhat robust to these things, and we have to accept that we will not be able to capture everything. But what at least we kind of do is we will measure whatever happens in the market. So I mean, one example, and then I'll answer your question properly, is does anybody still remember the other Volkswagen thing in the DAX with the big spike with the reverse turnover takeover? That the days following that, we got calls from literally every big fund company in Germany telling us to retrospectively remove VW from the index and restate the DAX without that movement, because at the time Volkswagen wasn't a particularly attractive share. Most of the active managers doing big blue chip German equity funds were underweight VW. The price shot through the roof. And they had a huge tracking error. And they asked us basically to fix that for them. And in the end, the answer, and this is very much the recipe cooking things, they shouldn't have put so much sugar in this thing, right? Just go by the recipe and you would have done exactly that performance. If that's great, or if that's a sustainable performance, is a different story. But you wouldn't have had a tracking error if you just stuck with the index. And so it sometimes works for you, it sometimes works against you. And I think with the dividends,
the hedge funds who were short.
But I mean, with the dividend point, I think there's a valid point in terms of, if you have a rule that says we pick the highest historic dividend payers and they stop paying, and we've seen some periods where it's even worse than what you've shown, where telecoms have paid big one year, didn't pay the next year, paid big again the following year. So you're doing everything wrong by looking back historically. So there's not that much you can do if you want to have a model that you're sticking to, and partially that's what we're selling, right? We're saying we stick to the model no matter what, and that actually on average does very well. But we do, so you do by now have this fast exit thing where you would say if somebody cancels their dividend altogether, we'd remove them. So on your list of 5, the first one we would have taken out, the other 4 would have stuck in. You can do more, right? I mean, the index rules, you set index rules at the beginning and you stick with them. Yeah? So you could now create a new dividend index that's the super reactive dividend index, where I'm trying to be more like you, and I'm putting into my rules something that I think I may have learned from you, is saying like, if somebody cuts their dividend, I should get rid of them right away. So I can put that in and say if there's a cut of more than 25%, 2 days later the component is out. Sure. But now I've made another index, and I'm not sure if I've actually achieved something that massively improves it. It just makes it more complicated. There's more turnover in it. So I kind of, unless somebody asks me to specifically build that, I probably wouldn't build it.
Well, you convinced me that there's a very useful role for both of you, for the index firm or the index tracking fund and the active manager. It just sounds like the roles are evolving as the importance of the index business increases. So it's going to be a very interesting thing to follow.